Facility Agreement, Finance section of CFO 100. Facility Agreement is an essential document to finance the company. The related knowledge to this agreement is finance, but the negotiation and the consideration of the agreement also depend on the legal perspective. So, CFO should handle this agreement properly and need to understand not only from a finance perspective but also legal perspective. It deviates from the specialty of accounting person and a finance person. But this is an essential point for the CFO to cover not only for those two categories but also for the other comprehensive business view. In this lecture, you can learn that legal perspective as CFO for facility agreements. On the left side, you can see several items that are needed to be considered in the facility agreement. The first one is interest rate, and the second one is the capacity and the currency. The third one is tenor and the payback. The fourth one is guarantee and collateral. The fifth one is covenant and default clause. And the last one is the bank policy for usage. Those 6 elements are core components of the facility agreement, which will be the main discussion point. As a CFO, you need to get favorable conditions for each part, but the issue is more complex. CFO is required to respect the bank's own interest, the company's interest, and the shareholders' interest, because each party has different interests, and the facility agreement is compromised among those parties. You can see this picture for your imagination. As a company, you, CFO, would like to get a lower interest rate, but to get that lower interest rate, a bank sometimes requires guarantee for safety. On the other hand, the shareholder would like to reduce their exposure, so they tend to hesitate to parent guarantee. In this way, each party has different interests, so the facility agreement will be output from those considerations and compromises. You may optimize for the company basis as CFO, but it is just one side of the perspective. You need to consider all of the points of a stakeholder as well. In next slide, you can see the detail of those 6 elements. In this slide, you can learn the basic 3 elements of facility agreement. CFO should give advice and pay attention to hidden costs and risks which do not appear on the surface. It looks easy for you to consider the arrangement for those 3 basic roles, but if you do not look at the detail of the facility agreement, it contains the hidden item which increases the risk and cost. The first item is interest rate. CFO must compare the interest rate from similar potential banks to get much lower favorable interest rates. But there is an arrangement that facility agreements may charge interest costs even without drawing down. It would help if you check the mechanism of interest cost to see whether the drawdown amount basis or the total capacity basis. Also, facility agreements sometimes contain a commitment fee that is charged without drawdown. So, low interest rate doesn't simply mean a good thing for the borrower side. It would help if you looked at carefully the total cost in the proposed from the banks. The second point is capacity and currency. It is also a basic point in the facility agreement. The necessary capacity should be calculated correctly, and sometimes the company arranges a separate working capital that can cover the sudden cash requirement. The currency should be matched with the revenue currency to naturally hedge the exposure of different currencies. In addition to that, using swap instrument or keeping open position for forex is one of the discussion points. The hedging cost will be very high when you want to hedge minor currency, so CFO considers this component between the balance of risk and the hedging cost. And the third item, tenor and payback. Suppose your project is a long-term basis project and the facility is required for such a long time. Long-term tenor is naturally nice, but it also means high interest rate. If you want to avoid the high interest rate, you need to take a risk because the bank can reject that short-term loan when renewal. The next point is drawing timing and the flexibility of payback. The flexibility of drawdown is a normal requirement, but you must also consider the flexibility of the payback. Free payback is the most favorable option for the company, but many banks set the clause to limit the early payback because they would like to secure their interest income for that facility. The balance of the safety and the flexibility is a discussion point in that third point. The CFO should find the hidden cost and risk to design proper agreement, though the business and finance teams recommend the agreement as good condition at the surface. You may find some side clauses in facility agreement apart from the basic clause related to interest rate, capacity amount, and tenor. The side clauses are also vital from the business perspective, and the points are related to each party's interest. You can see the detail of those points in this slide. The first one is guarantee and collateral. Generally speaking, parent guarantee by shareholders and collateral can reduce the interest rate and increase capacity. From the individual company CFO's perspective, it's better to get it. However, although parent guarantee can reduce the interest cost and enhance the company's profit, shareholders may want to reduce their exposure and deny guarantee and collateral by themselves. It is a common conflict of interest. Also, equity contribution agreement has the same function, which requires shareholders to inject money in case of lack of cash to maintain that business. And the second point is covenants and default clauses. Banks sometimes require stringent covenants and default clauses. It may limit the flexibility of the business. DE ratio, PAT figure, and DSCR are very common ones. The limitation of change of control and the consent process is also a big issue for some types of shareholders. The private equity fund and some shareholders want to sell out their share in short term. They don't like this type of clause to limit the flexibility of divestment. On the contrary, banks want to secure stable shareholders and don't like those members' flexibilities. The arrangement depends on the strategy of each party. Lastly, bank policy and fund usage are also vital clauses. It is out of the main issues, but it is a general clause. The clause mentions how the company uses the fund. For example, the company can use it for capex or fixed facility only. The company cannot use it for the fund for the other purpose. And it sometimes sets the requirement of using the fund only for one business sector and specifies the industry prohibited. Recent banks prefer to lend money to something other than coal mining business due to ESG. So banks put the limitation of usage of fund. Even though the bank proposed a very low interest rate and good other conditions, you should see a long-term partnership with the bank if the bank has a policy to conflict with your company's direction. CFO should check the bank's policy and global movement. Accounting and finance managers are not always good at understanding legal documents. As you can see in this lecture, those are many legal documents and a perspective discussion point. If you want to become a good CFO, you should learn those main elements and get support of legal division to review and brush up facility agreement to avoid the unnecessary cost and risk.